Imagine a nation where decisions are made instantly, without endless debates or political gridlock. A single vision, executed with ruthless efficiency, transforming a struggling economy into a powerhouse. Sounds appealing, doesn't it? For decades, countries like China, Singapore, and even Pinochet's Chile experienced astonishing growth under authoritarian rule. But here's the uncomfortable truth. This initial boom often comes with a hidden cost, a ticking time bomb that eventually detonates, leaving behind economic ruin and social unrest. What makes dictatorship so effective at kickstarting growth, and why do they almost always fail in the long run? More importantly, if you are an investor, how do you price the risk of property rights in a country where the rule of law can change with a single decree? Stay tuned, because the answers might surprise you. Autocratic regimes often boast a significant advantage in their early stages, the ability to make and implement decisions with incredible speed and efficiency. There's no need for lengthy parliamentary debates or navigating complex political compromises. A single leader or a small elite can dictate economic policy, often with a clear long-term vision, unburdened by the short-term demands of electoral cycles. Consider China under Deng Xiaoping. His market-oriented reforms, though radical for their time, were pushed through with remarkable speed, transforming a largely agrarian society into an industrial powerhouse. The centralized control allowed for massive infrastructure projects and rapid industrialization, often bypassing environmental or social concerns that might slow down a democratic process. Singapore, under Lee Kuan Yew, is another prime example. A small island nation with no natural resources, it achieved extraordinary economic success through a highly centralized, technocratic government. Policies focused on education, attracting foreign investment, and strict social controls were implemented without significant political opposition, creating a stable and predictable environment for business. Even in more controversial cases like Augusto Pinochet's Chile, we saw an initial period of rapid economic restructuring. The Chicago Boys, a group of Chilean economists trained at the University of Chicago, were given free rein to implement radical free market reforms, privatizing state-owned industries and opening up the economy. While the human cost was immense, the economic indicators initially showed impressive growth. This ability to suppress dissent and push through unpopular but economically rational policies is a hallmark of the autocratic advantage. Despite the initial allure, the autocratic advantage often proves to be a short-lived illusion. The very mechanisms that enable rapid early growth eventually become the seeds of long-term economic stagnation and collapse. One of the most critical issues is the lack of innovation and adaptability. In a system built on suppressing dissent, critical feedback is stifled. New ideas, especially those that challenge the status quo or the leader's vision, are often seen with suspicion, leading to a brain drain and a decline in creative problem-solving. Furthermore, the concentration of power inevitably breeds corruption and rent-seeking. When institutions are weak and accountability is absent, those in power can easily divert resources for personal gain, leading to cronyism and inefficient allocation of capital. This erodes public trust and distorts market mechanisms, making it impossible for a truly competitive and fair economy to flourish. Perhaps the most damaging long-term effect is the erosion of property rights and the rule of law. In an autocratic state, the law is often an extension of the ruler's will, not an independent framework protecting citizens and businesses. Arbitrary decision-making, sudden nationalizations, or the seizure of assets can occur with little to no recourse, fundamentally undermining investor confidence and making long-term planning a perilous gamble. And finally, autocracies are inherently vulnerable to succession crises. The absence of clear, institutionalized transfer of power often leads to instability, power struggles, and even civil unrest upon a leader's departure or incapacitation. This uncertainty alone can send shockwaves through an economy, deterring investment and causing capital flight. Consider Putin's Russia. His first decade saw significant economic growth, largely fueled by rising oil prices and a degree of stabilization after the chaotic 1990s. However, as his rule solidified and institutions weakened, the economy became increasingly reliant on natural resources, failing to diversify. Corruption became endemic, property rights remained precarious, and innovation lagged. The initial boom gave way to stagnation, demonstrating how even resource autocracies eventually succumb to these inherent flaws. The contrast between Putin's first 10 years and his last 10 years offers a stark lesson in the long-term economic trajectory of authoritarianism. Now, let's take a deeper look at a case that often sparks heated debate: Augusto Pinochet's Chile. From 1973 to 1990, Chile was under a military dictatorship that, paradoxically, implemented some of the most radical free market reforms in Latin America. Guided by a group of economists known as the Chicago Boys, who were trained at the University of Chicago, Pinochet's regime privatized state-owned industries, opened up markets, and drastically cut government spending. Initially, these reforms led to impressive economic growth, controlled inflation, and attracted foreign investment. It was hailed by some as an economic miracle. However, this economic success came at an immense human cost. The regime was responsible for widespread human rights abuses, political repression, and a significant increase in social inequality. While the economic model laid some groundwork for future prosperity, the political system was brutal and unsustainable. The long-term legacy of Pinochet's era is a complex one, an economic framework that largely persisted after his departure, but a political system that was ultimately rejected by the Chilean people. This case study highlights the stark trade-offs that can occur under authoritarian rule. Given this complex picture, how do investors navigate the treacherous waters of authoritarian economies? The dilemma is clear. These regimes often present the allure of rapid, almost unprecedented growth, promising high returns. Yet this comes hand in hand with an equally high, if not higher, risk. The danger of sudden, arbitrary policy shifts, nationalizations, or even outright asset seizures is a constant shadow hanging over investments. For investors, the lack of robust property rights and an independent rule of law isn't just a theoretical concern, it's a tangible premium that must be factored into every decision. How do you value an asset when its ownership can be challenged by a single decree, or when contracts can be unilaterally broken by the state? This uncertainty demands a higher rate of return to compensate for the elevated risk, making these markets inherently more volatile and less predictable. Therefore, sophisticated investors in authoritarian states often prioritize exit strategies. The ability to quickly liquidate assets and move capital out of the country becomes paramount. This emphasizes the importance of liquidity and diversification, ensuring that no single investment or market can trap capital if the political winds suddenly shift. Investing in these environments is not for the faint of heart. It requires a deep understanding of political dynamics, a high tolerance for risk, and a clear plan for when to get out. So, while autocracies might offer a tempting shortcut to economic prosperity, history shows us that true sustainable wealth is built on a foundation of strong institutions, rule of law, and the free exchange of ideas. The initial boom is often just a mirage, hiding the deep structural flaws that eventually lead to collapse. What do you think? Is there ever a scenario where authoritarianism truly benefits an economy in the long run? Share your thoughts in the comments below. And if you want to understand how other political systems shape our financial world, make sure to watch our next video on monarchy. Don't forget to like, share, and subscribe to Real Economic Truth for more insights into the hidden forces shaping our economies.